Welcome to another episode of Breakaway from the Rat Race, and today I have the pleasure of speaking with Jacob Vanderslice. Jacob is a co-founder of VanWest Partners, a Denver-based real estate investment firm focusing on the acquisition and management of self-storage centers and other opportunistic real estate throughout the United States. VanWest has established a track record with over $250 million in real estate assets. Jacob and his partners' success is driven by a commitment to delivering an expertly executed, adaptable strategy with an institutional investment approach. Welcome to the show, Jacob.
Thanks for having us on today. Happy to be here.
Wow, my pleasure. So let's talk about we're going to talk about the self-storage space in general, kind of like how to get started, how to how to find the right location, the right size for people that want to get started. But also, I think you've taken this from like the initial level of investing in a self-storage facility to making it into a fund. That's what we mean when we talk about institutionalizing the investment. So let's talk about kind of like at the beginning, kind of how someone would get started right now if they're interested in getting involved in investing in self-storage.
Yeah, there's really three ways to get in the business. One way is to buy a REIT stock. You could buy Extra Space, Life Storage, CubeSmart, Public. The advantages to that is you've got liquidity. You can sell your shares anytime, but you're not participating in the depreciation. You're kind of at the mercy of the whims of the stock market, kind of outside forces affecting the valuations. And the second way is to buy your own storage facility. We can expand on that further. And the third way is to invest in a private syndication or fund vehicle. There's lots of folks out there like us who have fund syndications. They raise capital from investors. They go out and buy deals and create value with more efficient operational platforms and then hopefully deliver a good return. If you're looking to do your own deal, there's a few things to consider. First of all, you have to have some capital, of course. Generally, the really low basis, inexpensive storage facilities are probably not deals you want to own. They're in rural locations, the quality's small, the net rentable square footage is small. Generally, the floor is of a decent quality assets, probably like $2.5–3 million and kind of going up from there. As far as things to consider when you're underwriting a potential storage facility, the first thing you want to look at are the supply ratios in the submarket. Self-storage is very local supply sensitive, and your rates and your occupancies can be affected by somebody building a new product nearby or a market that's got way too much product already. Rates and occupancies go down. Nationally, there's about 8 square feet per capita. And some markets can sustain higher supply ratios. Some need lower supply ratios to keep rents buoyant. So that's one thing to consider. And if you find a deal in a market that makes sense, you got to think about how you're going to operate it. And you've got two options there. You can outsource the management to a third party, which we used to do. And we found over time that I think your interests with third parties are inherently misaligned, at least in the storage business. There's a lot of ancillary fee income that third-party management companies will keep. So we started self-managing. So if you did your first deal and you wanted to self-manage it, you got to think about who you're going to hire to oversee the facility. You can run it remotely, potentially, depending on the deal type and the size, software systems, operational challenges. It's just like any business. It's not easy. You're basically starting a new business. So yeah, supply ratios and then kind of how you're going to operate it are things to consider, not to mention finding the money to buy it.
Yeah. So exactly. So the entry point is a little bit higher, obviously, 2.5 million. You were saying, obviously, you can find things that are a little bit smaller in price. You don't really recommend that because it would tend to be in more rural areas and kind of like maybe
those deal types. There's not a lot of buyers for them, and frankly, we often say that doing a big deal takes as much time, if not less time, than doing a small deal. You still have to get your bank loan in place. You have to get your third-party reports, your phase 1, your phase 2, your survey. And some of these smaller deals that might be $300K to $500K are just very low quality and kind of locations that nobody really wants to be, which is why they're cheap. So you might find a cheap one with on paper what looks to be a really good cap rate, but when it comes time to monetize it, you might have trouble finding buyers to take you out.
Yeah. And I think if we're comparing that, let's say, to apartment buildings where they also have like multiple units, the data around the self-storage is not as readily available as we have for multifamily. Like if we can go in a rentometer and then find data about rental space around. Is there something like that for self-storage?
Yeah, we use a variety of different tools at our disposal to determine rental rates. Some of them are kind of third-party software systems like Radius. That's one example. We also built internally a customized software platform that will scrape all the data from the various websites in a given submarket, and it'll give us historic asking rates, and you can kind of see trends based on seasonality. So for example, if you're in the Midwest, rents go down quite a bit in the wintertime because it's cold and nobody's moving, and they go up in the summertime. And those peaks and troughs are a little bit less pronounced where you are, for example, in Fort Lauderdale. So we have an in-house system we look at. We use Radius, but we also get on the phone. Rates on these are very difficult to forecast to a degree because all the leases are month to month. And you've got dozens of different unit types. You've got 5x10s, 10x10s, 10x15s, 10x20s. You got parking spaces. You got 5x5s. So you have to determine the most efficient unit mix on a deal. And then you have to determine whether the rates that on the deal you're buying are below market. And you really do that by using these software systems, but also getting on the phone, cold calling other owners, other operators, secret shopping facilities, tastefully asking how many units do you have available? What are some promotions you're running right now? And all these different kind of data sets we interpolate together, and they help us make a more informed acquisition decision.
Yeah. Yeah, that's right. There's a lot more variety. It's not just like 1 bedroom, 2 bedroom, 3 bedrooms, and then you have.
Yeah, I mean, in addition to the unit types, you've got climate controlled, non-climate controlled. Is it elevator accessed? Is it ground floor? So there's lots of different types of pricing that each unit will command based on the type, the location, and the size.
Yeah, your price matrix is huge.
Yeah, each unit arguably is its own product.
Yeah.
So if you have a 10x10 by the front door, that's really easy to access, that's going to command a pricing premium compared to a 10x10 that you have to ride an elevator up 2 stories and then walk 100 feet to get to.
Yeah, so it must be. So how do you are you then kind of like looking at the overall unit mix, like the number of units, and kind of come up with kind of like what the revenue ratio is? Like, do you have like a...
Yeah, it's not unlike residential. The smaller unit size you have, the higher you can push your per square foot rent, but the lower the gross dollar monthly revenue is. So on a 5x5, for example, you might be able to get $2.50 a foot per month, but on a 10x20, you might only get $1.20 per foot per month.
Yeah.
But it's a lot bigger, so you have more gross dollar revenue. So the unit mix is really important. Generally, in more infill urban locations, the average unit size is going to be smaller. You'll have a lot more lockers, a lot more 5x5s, 5x10s, and your suburban locations, where there's a lot of space, homes are bigger. It's not an infill dense environment. If people are storing, they generally need a bigger unit. So your 5x5s or smaller unit types and those types of locations are probably not going to be in high demand. So you generally have a larger average unit size in those kind of more suburban locations. Yeah. So curating and understanding that unit mix and then forecasting the revenue stream for that unit mix is kind of the art and the science behind the business.
I could see that. Yeah. So the other thing too is that there's a lot of things, like storage is not just storage, right? So, I mean, you hinted at like parking spots. So, if you have a piece of land, I mean, I've seen, you kind of drive around and it said, yeah, you rent a locker, but you see also RVs that are parked or boat that are parked on the lot. So these are additional kind of like revenue stream that can be done there. So you kind of have to think about that as well when you're looking at the potential for a self-storage facility.
Yeah, if you buy a facility let's say it's 40,000 feet and it's got some excess land that's not being used, you could build more storage units. That's going to be pretty capital intensive, or you can make a parking lot, and that's a lot less capital intensive. So we have a number of deals in our portfolio that had excess land, and we spent a pretty nominal amount of investment dollars to convert that into parking. And the return on that incremental additional basis is pretty extraordinary. I think we spend $100,000 paving a parking lot on a deal in North Carolina, and we get probably $20,000 a year in revenue off of it. So a 20% current return is good. It's not a ton of gross dollars, but when you put a cap rate on that, you've created a fair amount of value. So you can boat and RV parkings, you can add covered parking potentially, which is obviously a little more capital intensive, but you might command more of a premium per space, especially if you add power. People want to put their RVs on trickle chargers. They don't want them out baking in the sun. So typically that unit type will command a premium as well. But yeah, lots of different product types for sure.
And and then there was also some other self-storage facilities. They also help you with like moving, with truck rentals, with all kinds of different things that are kind of like off the cuff, kind of like almost another business within the business.
Yeah, one interesting thing about the business is there is a lot of ancillary revenue streams, and a couple examples are tenant insurance. It's kind of like car rental insurance. You probably decline it when you travel because you've got coverage on your auto policy or your Chase Sapphire card. But a lot of people buy that insurance, and the arbitrage on that's extraordinary. I mean, the margins are huge, and we require our customers to buy a protection plan from us to cover their contents, because believe it or not, in storage, customarily, the lease stipulates that the ownership group is not responsible for theft, fire, flood, pests, whatever the case might be. So between that insurance revenue, late fees, merchandise sales, one-time move-in fees, and truck rentals, which you touched on a moment ago, all those income streams comprise about 10% of our top line revenue. So it's pretty substantial. Yeah. If you buy a facility that doesn't have those in place, if you do nothing else in the first year of operations, you can generally raise your revenue by 10% just by implementing those different ancillary revenue streams.
Yeah. And then, so would you recommend, but these additional revenue stream, I mean, they require additional management, like additional operations on if I'm going to own it myself, that means now I have to figure out how to do truck rental and truck rental agreement and insurance.
Yeah. It's operationally intensive. It's somewhat of a common misconception that self-storage is kind of fire and forget, no tenants, no toilets, no problems. And that's true to a degree, but it's not an easy business. We have theft issues. We have trucks backing into gate systems and gates going down, trucks bumping into our buildings and breaking doors, natural disasters, hurricanes in Florida, thunderstorms in Oklahoma. So there's a lot to it. It's definitely an operationally intensive business. But as it relates to truck rentals, we don't have any of our own trucks. We use third parties like U-Haul and Penske. A revenue sharing agreement where they can park their trucks on our site. It's an amenity for our customers because generally if they're storing, they're probably needing a truck to move stuff. But the revenue is not too meaningful. Maybe a given site might generate $1,500 or $2,000 a month. But the challenge with truck rentals, to tie into your kind of personnel and operations question, is it takes a lot of time for your on-site manager to do a truck rental. I don't know if you've ever rented a U-Haul, but you have to go in there, you have to fill out your information, give them a copy of your ID. They have to walk the truck with you, make sure it's working okay. And at the time that person's renting that truck, they may not be servicing a customer that wants to come in and rent a storage unit. So there's a good return on those, but you have to be careful with the kind of time suck that it creates for your on-site staff.
Yeah. And so, and then you mentioned a little bit about kind of like a lot of people think it's like, buy it and forget it kind of thing. And it's going to make money on its own, because there's a lot of systems out there, and it seems pretty easy where you basically you don't have to talk to a person. You can just go to the facility, and then somehow you can rent a unit. They tell you which unit to get to. You can go in and out to your own unit without having to talk to anybody. So from a lot of that perspective, it's self-servicing. But that sounds a little bit too good to be true. There must be some,
Yeah, it's certainly true to a degree. I mean, the way our management platform is set up is our customers can rent a unit, sign their lease, get their gate code, and move in without ever talking to or seeing a person. We experimented with remote management on a number of facilities kind of early in our self-storage investing careers. And either we weren't good at it or it just doesn't work that well. There's a lot of shops out there who have figured it out, but we couldn't. I think the value of having a person there cannot be overstated just because of the problems that pop up. Customers can't find their units. A lot of people, believe it or not, especially in our more small town locations, they want to walk in to make a payment and kind of shoot the breeze with the on-site for a few minutes.
Yeah.
So having a person there is important, but we try to set up our operations platform so that our customers who want to liaise with a human can, and those who don't aren't required to and don't have to. Yeah. I prefer, like when I get my Starbucks order, I always do it on my phone.
Yeah.
The baristas are awesome, but I don't want to talk to them and I want to wait in line. I show up, I take it off the counter and I leave. And a lot of our customers are the same that store with us, but some want to, talk to that barista.
Yeah. Well, definitely. Yeah. People want to be serviced and, they want to get their service different ways. Some people, they just want to be online. I don't want to talk to anybody. And other people, they just want to have like more of a customer service touch and, walk the unit and really kind of like compare and say, oh, maybe this be good for that and all that kind of stuff. So,
yeah, certainly.
The other thing too is, again, we're talking about people that want to get started into this. And then, so what should they be renting something or buying something that is like turnkey, that's everything is done for them? Or would you recommend that someone take a little bit, maybe a smaller thing, a smaller self-storage, and then start building the system, and then maybe doing renovations and, building more units or paving some areas, making a parking lot for additional rent? Or how would you recommend someone to approach that?
Yeah, it depends on your business plan. Generally, I think it makes sense to target deals that are existing. You don't want to do your first deal as a development project, I don't think. Yeah, that'd be kind of baptism by fire because you got to build it first, then you have to operate it.
Like that.
Yeah, that was our first project, by the way. We built a big one in downtown Denver, and we learned a lot because we didn't know what we didn't know at the time.
Yeah,
but generally, you want to target something that's kind of mom and pop owned. Inefficiently managed. Maybe they don't have a website in place. It's been there for 20 years. Their rates are below market. And of course, like any real estate investment vehicle or strategy, you want a story for creating value. And in commercial real estate and residential for that matter, you create value by growing revenue, right? Increasing existing rates, growing physical occupancy. So that deal type is exactly what we target within our fund platform. Just these kind of undercapitalized, undermanaged, mom and pop owned facilities. They just kind of fell into the business. They've owned it for a long time and they want to kind of monetize and ride off into the sunset. And we can generally pay them a pretty fair price based on their existing revenue because their revenues are low. They're not good at being dynamic with their revenue management. They're not pushing rates on existing customers. So that's the type of deal you want to look for with that value creation component, below market rents. Maybe there's a story for growing physical occupancy, adding some technology systems in place, like a more efficient property management software, gate systems, camera systems. So a lot to consider, but you definitely want to deal with some meat on the bone for sure.
Yeah. So yeah, exactly. And I think there's a way to do it, like with something that is solid. You don't have to do any, you don't have any deferred maintenance and stuff like that. It's just adding additional revenue streams to something that a solid structure, a solid setup, and then say, oh yeah, I'm going to market that a little bit better. I'm going to do some other things, maybe other services, and then grow the revenue that way. That makes sense.
Yeah, tiny little increases in revenue, when you put a cap rate on those increases, create exponential value increases. I mean, if you grow revenue by 20 grand a year, you put a 5% cap rate on that, your deal's worth a lot more than it was before you grew that revenue.
Exactly.
Yeah.
Would you recommend you have a property management? Obviously, as you gain more experience, you decide to move away from the property management kind of setup. What is the typical percentage that the property manager would ask for of gross revenue for managing the property?
Well, we self-manage our entire portfolio, but we didn't used to do that. When we first got in the business, we outsourced our management to the national REITs. And At the time, we were paying them a management fee of 6% of their monthly gross receipts, of the deal's monthly gross receipts. But we learned over time that, yeah, you're paying a 6% fee, but you're actually paying a lot more than 6%. So they'll burden stores with marketing allocations and marketing dollars that they can't necessarily defend those dollars driving customer traffic directly to your facility. If there's 10 stores in a region and they've got a $1 million budget for that region, your store's getting hit with $100,000 a year.
Yeah.
And the many third-party management companies, specifically the REITs, we talked about ancillary revenue streams earlier. A lot of them will keep a big portion of those ancillary income streams, specifically tenant insurance. Okay. There's one REIT out there that keeps all the tenant insurance. So any tenant insurance revenue they generate, 100% of that goes into their pocket and not the ownership groups. Yeah. Other REITs will keep maybe 50%. So when you hire a third-party manager, you've got to understand not only the management fee you're paying, but what are their marketing allocations, what are their payroll allocations, and how much of those ancillary income streams are they not sharing with you, the actual owner?
Yeah, good point. What any kind of trends in terms of self-storage, like new things that you're seeing right now happening with the self-storage market?
Yeah, some of this commentary sort of transcends asset classes, I think. Whether it's storage or multifamily, whatever the asset class might be, we're seeing transaction volume much lower than it was a year ago. Mm-hmm. Fewer people are selling their facilities and fewer people are buying. So think about if you're an owner right now, you've owned it for 10 years. Let's say you refinanced it 3 years ago with really cheap 10-year debt. You might be able to make money when you sell, but you're gonna pay off a 3.5% rate. You're gonna borrow at a 7%. So why sell? Just strap in, enjoy that debt runway, enjoy the cash flow. And owners still want a pricing premium. They want values from a year or two ago. Yeah. And buyers are saying, hey, listen, here's my interest rate, here's my model. I can't pay you your price. So they're saying, okay, well, I'm not going to sell. Yeah. So transaction volume is definitely down. On the valuation side, though, it really depends on the deal type. But we're seeing cap rates pretty compressed still. The deals we're not seeing transact as much are deals with a heavier value creation component, like a certificate of occupancy purchase, a lease-up deal, development projects. Those are tougher to get financing for. And the forecasting those revenues is a lot more risky than buying a deal that's been there for 10 years, it's full. So we're seeing those types of deals trade more infrequently. As far as what's trading well still, deals that have done most of the heavy lifting, where the ownership group is kind of, say, lease it up from 0 to 75%. A new buyer might come in and say, all right, a lot of the risk has been taken off the table in that lease up. I can see a little bit more meat on the bone by taking it from 75 to 90 and doing some rate increases. I'll pay this person a pretty compressed cap rate, knowing that maybe I can get to a 6 cap on year 2. So those deals are still trading pretty aggressively. And the final comment I'll make here is on consumer demand. So the COVID years created an absolute influx of self-storage customers. A lot of people were moving. They were clearing out their 3rd bedrooms for the home office. Self-storage demand just skyrocketed. And what's typically in the business is seasonality, like we talked about a few minutes ago. And during the COVID years, and I'm tired of talking about COVID as much as anybody else here listening, but it's yes about the market. We've got to touch on it for a moment. During the COVID years, seasonality kind of went out the window. Winter was still crazy. It's always crazy, but summer was still crazy. And we're seeing consumer demand kind of moderate back down to more pre-pandemic levels. Seasonality's kind of returned. Generally, the consumer demand kind of reduces in the fall lately. Like last fall, it kind of went down. It came back up this summer. It's probably going to go down again this fall and winter. So on the demand side, we're returning to more of a normal market environment versus kind of an insane, untenable revenue growth environment, which we had for a number of years.
If you're planning to buy a facility right now, you kind of have to watch out and don't expect that the revenue necessarily is going to continue to go up over like it has over the last 2 years. You kind of have to think that is going to normalize, maybe taper down a little bit.
Yeah, a lot of operators, we look at a lot of deals. I think in 2022, we looked at 900 potential acquisitions.
Wow.
We financially modeled 250 and we closed on 8. So it's a pretty wide funnel and then narrow at the bottom.
Yeah.
And the kind of scary thing to a degree is a lot of the deals that we passed on or made an offer on that we didn't get traded for substantially higher pricing than we could have paid. And I think a lot of operators were making the assumption that that increased consumer demand was going to continue for a lot longer than it did. And a lot of these deals were bought with floating rate debt at the same time. They had a going in interest rate of 2 or 2.5%. And if they didn't buy a rate cap, that's probably gone up to 7.5 or even 8%, depending on what spread they're indexed or what they're indexed again, what they're against and what their spread is. So you're going to see some pain in the market, I think, with deals that were acquired with risky financing and kind of unreasonable underwriting assumptions. We're not seeing much of that yet, but I think we're still kind of early on in this new environment, and we're definitely seeing some cracks in the foundation. So we'll see how that unfolds in the coming quarters.
Are you saying that there's going to be an opportunity coming in self-storage for people that are going to be underwater, or?
I think so. I don't think it's going to be so much of a. I mean, I'll give you an example. Let's say you bought a property 2 years ago on a floating rate loan and you finance it at 70%. And your going in interest rate was, call it 2.5%. It was SOFR plus 250. Well, today your interest rate is probably closer to 7.5 or approaching 8%. And your loan's going to mature pretty soon because it was a bridge loan, right? So you might have hit your NOI growth targets, but your NOI did not increase as fast as your interest rate did. So now your loan's going to mature. So what are your options? Well, you can either refinance or you can sell.
Yeah.
To refinance, it's going to be a challenge because your fixed rate debt's probably going to be 7% or so, somewhere in there. And lenders have pulled back their leverage quite a bit. So if a lender was reliably doing 70% 2 years ago, today they're probably doing 55 or 60. Yeah. So what does that mean? It means you're gonna have to bring cash to the table to refinance. Yeah. And if you're not positioned to do that and your loan matures, you could be in technical default. So your other option is to sell. Well, you're in it for a pretty high basis. You might have paid too much, and buyers are looking at the price you want, and they're having the same financing issue that you would have if you tried to refinance. So they can't pay you the price you want. So what's going to have to happen? Well, values will have to come down. Yeah. Inevitably, you do the math. You can't retain a compressed cap rate environment in a rising interest rate environment. Eventually, they have to kind of start to line up a little bit. So. Yeah. We're not seeing the pain yet. We're not saying that self-storage values have dropped 20% in the last year. That's not the case. But there's definitely some deals out there that we've seen that have got some cash flow and some balance sheet issues for sure.
Okay. Anything else in the economy that you see that any other economic trend that you see would affect the self-storage market?
Well, obviously, we've all been talking about inflation for over however long we have, over a year. Inflation is kind of a double-edged sword in self-storage because our leases are month to month. So on the revenue side, we can increase rates very dynamically because no one's locked in on a long-term lease. And generally, our consumers have digested those rate increases pretty well. But their gas has gone up, their rent's gone up, their food and utilities have gone up. How much more can they afford to pay before they kind of break and say, I'm not storing anymore? So to a degree, inflationary pressures are kind of a benefit on the revenue side, but the downside to it is we're paying our on-site managers a lot more than we were a couple of years ago. It's tough to find anybody that's reasonably talented and reliable. Our utility costs have gone up, our property taxes and insurance have gone through the roof. So we're seeing increases in revenue, but we're also seeing increases in our operating expenses. In the supposed recession that's looming, I saved a screenshot, by the way, from about a year ago from the Drudge report. And it was the homepage with like a big red alarm bell saying recession imminent, recession imminent. That was a year ago. And what's happened, right? Unemployment's down. Job creation is twice what we thought it would be. Where's the recession, right? So if there is a recession coming, self-storage typically responds pretty well to economic disruption events. if people are moving up and down the economic ladder more quickly and more often, they inherently need more storage. They're
Right.
downsizing to an apartment, they're getting a job, they're losing a job, they're getting married or divorced. Life changes really drive self-storage demand. And if there's a recession, there's going to be a lot more life changes, and hopefully consumer demand will be robust. But yeah, we've got the double-edged sword of inflation, and if there's a downturn coming, we think it's a good asset class to be defensible and well positioned in.
And I think the millennials too, I think they were they were about to go into what's called like family formation, kind of like getting together with their partners, starting a family and all that kind of stuff, renting a house or buying a house and getting out of the parental home or the apartment. And that was stunned by the pandemic again. So now I'm thinking, and then after that we had the high inflation and all the uncertainty and a high interest rate, so they couldn't buy a house and all that kind of stuff. So yeah, so I think, so if these people start, these millennials start actually going and doing family formation the way they should,
Yeah.
what would be the trend then on the self-storage? Are they gonna, it sounds to me like you're saying that whenever you see any kind of movement up or down, it causes some kind of increase or demand in the self-storage facilities.
Yeah, a lot of our millennial customers, generally they're in more urban infill locations. They're living in smaller apartments, and they'll rent our storage units to keep their seasonal gear in, like their mountain bikes, their golf clubs, their camping gear, their skis, and they come by a few times a year and kind of swap out their gear. Yeah, family formation is a good thing for the industry, but I think that family formation is going to continue to be delayed. If you're a millennial, you've been in the workforce for a while, you're making a little bit of money now. That dream of home ownership has gotten stretched out even further.
Yeah.
You might have been touring a bunch of houses a year and a half ago, and you wrote 10 offers, you didn't get anything, and at the time you were barely qualified at 3% interest or 3.5%. Well, those home values, this is a big generalization, but those home values are pretty close to where they were a year and a half ago. And now your interest rate is 6.5 or 7. Yeah. So that buyer is going to be a renter for much longer than they anticipated. Yeah. And generally, renters are more likely to need self-storage than homeowners are, because they're moving constantly. Apartment units are smaller, they've got extra stuff to keep. So we'll see.
And I can imagine a couple moving together, they have duplicate stuff, and then they say, well, I'm just going to store my extra sofa, all my extras until we decide what to do, kind of thing.
Yeah, what's amazing, no one likes to store. Okay, so if you go to a storage facility, even if you're there because you just got a new house, you got a new job, you're moving up the economic ladder, you're still, no one likes to move stuff or go to a storage facility. Yeah. But people will put their stuff in there and they don't want to deal with it. No. So they won't think about it. It auto drafts out of their bank account or on their credit card. And our average customer stores with us for over 2 years. So that duplicate sofa you were talking about, I guarantee you, after you paid 2 years of storage rent, you could have bought a new one. That's right. Or you could have just given it away and been much further ahead. So it's kind of a unique asset class, and that people pay a lot of money to store stuff that's not really worth that much money.
That's right. Yeah, it's counterintuitive. People don't want to throw it away, but then as I've gone through this exercise many times, I said, "What's the value? What's the value of this? This table is $120." Especially when students, right? My kids, they move out of an apartment and they say, "Oh, and they go somewhere else. I'm going to store that." All right, table, chairs. Okay, the content is $600, and you're paying $75 a month. And so you're going to have that, like, 10 months in there, and just throw it out now. Don't deal with it. And then you buy it brand new in 10 months whenever you're moving out into a new apartment. So
that's
anyway, I still love self-storage. I think it's just like it's such human nature to.
Oh yeah, no, it is human nature. But when you do the math on the ROI of storing your stuff, if people actually did that, we'd probably lose a lot of customers, but they don't.
So I'll edit that out. Don't worry.
yeah, certainly.
So the other thing too is that obviously, we've talked a lot about people that are going to start into this and all, and but you can see that, like, if you're thinking right now, if the listener is thinking about getting into this space, it's a complex space. It's not as easy as getting some kind of like rental space and stuff like that. So you mentioned going with a REIT to kind of like get some kind of involved on that. But you went a different way. You went by creating basically a fund to basically manage the portfolio. So tell us a little bit more about that. Obviously, you gained a lot of experience, and you decide now to let's pull funds from other individuals that are interested in that space, but they want to have all the benefits or some of the benefits of owning self-storage without having all the headaches of managing self-storage.
Yeah, in the private real estate investment space, there's generally two vehicles you can participate in. There are single asset syndications, which, as the name suggests, it's one deal. A sponsor forms an LLC, they put together a PPM, they raise capital for a project, they make distributions, hopefully they make a good return, eventually they sell it. That's one deal. A fund is similar to a syndication, but a fund is a collection of assets. It's a multi-property strategy, a multi-property portfolio. And one of the reasons we like the fund strategy versus single asset syndications, we do both. We do development deals and syndications and value add acquisitions in our funds. But one of the reasons I think funds are attractive is the inherent cash flow and geographic diversification that a multi-property portfolio offers versus investing in one deal. So inevitably, if you have 20 properties in a fund, 2 of those in a given quarter might fall behind forecasts for whatever reason, unforeseen capital expenses, a drop in occupancy, a drop in revenue, a new competitor. But those 2 deals that might be underperforming are balanced out by the other 18 that are ideally performing on or ahead of forecast. So you could liken a storage fund or any fund for that matter to almost like a mutual fund of that property type. Just you're inherently more diversified. If you're considering launching a fund, which I guess I should say, if you've never done a storage deal, you may not want to launch a self-storage fund. But if you want to put together a fund for anything, there's a lot of considerations to think about. One is engaging a good attorney to put together your offering documents, your risk disclosures. How are people signing the offering documents? You generally have to hire a fund administrator and a portal host to set up all your software systems in for like distribution reporting and downloading documents. You've got the tax side to consider. And then the 2 biggest things really are how are you going to find deals and how are you going to raise money, right? Any fund needs really needs 3 things. It needs an operational platform, it needs deal flow, and it needs capital. And we've got teams set up around all those. And we have a lot to learn still, but what we've built certainly didn't happen overnight. It didn't happen without making a lot of mistakes.
Yeah. Oh, that's good. So obviously, having a good team to set up your fund, but do you accept your fund accept funds from other investors that want to invest in self-storage, or is this like private, only certain individuals that are part of the small group?
We do. There's really 2 types of SEC designations for these private investment vehicles. One is a 506B, as in Bravo. And that means you can accept investors that are not accredited, but you can't generally solicit or advertise. Mm-hmm. And accreditation simply means, everyone probably knows, but to touch on it, if you make $200,000 a year if you're single, or $300,000 a year if you're married, you're accredited, or your net worth has to be $1 million outside of your primary residence. So either of those 2 options means you're accredited. So we're a 506C fund, which means that we can generally solicit, we can publicly talk about our fund, but we can only accept accredited investors into the fund. Mm-hmm. So it's open for anybody who's accredited.
Yeah. Okay. So right now, your fund is only open for accredited investors.
Correct. Correct.
Okay. Very good. Any plans to make it open to a general public and being able to do like a general solicitation?
We've done a few offerings over the years on smaller syndications on different product types, like kind of infill retail that were 506B operations.
Yeah.
In our opinion, as you kind of grow in size, the 506C designation is just a cleaner way to do it.
Yeah.
We don't want we don't necessarily want somebody who's got $100,000 to their name giving us 50 of that, right? Because then we'll feel bad either way if we screw up, but we'd feel real bad in that case. So we'll probably for the foreseeable future keep our designations 506C.
Okay.
Yeah.
Sounds good. Jacob, anywhere if people want to reach out to you, they want to know more about your fund, they're accredited investors, and they just they're generally interested in the space, or they want to diversify from other investments that they have, what's the best way for them to reach you?
Yeah, we always love to talk shop about real estate. Folks can email me, jacob@vanwestpartners.com. They can go to our website, vanwestpartners.com, or they can hit me on LinkedIn, Jacob Vanderslice.
Excellent. Well, Jacob, thank you very much. Thank you for sharing your experience and knowledge with us. And we'll talk to you later.
Eric, thanks for having us on. Take care.
Take care.
Thank you for listening to Break Away from the Rat Race with your host, Eric Martel. If you want to share your story and experience with our listeners, please message us on Facebook at Break Away from the Rat Race. Also, please subscribe to our YouTube channel and our podcast on iTunes.